Thank you and welcome. Thanks for coming. Like Azar says, I do a lot of stuff. I'm an entrepreneur. Courtney did a great job presenting and in talking about himself, and I usually don't like to talk about myself. I just sort of gloss it over. But I thought, well, he did such a good job. I'll expand a little bit and tell you about what I do. I actually came to Canada at 17 years old by myself to go to school as a foreign student. Spent 7 years in school. Went to George Brown College at Ryerson. Did electrical engineering, instrumentation technology, digital electronics. Well, 7 years is a long time. But when I was at Ryerson, the one thing that I learned was computer programming. And so anyways, I didn't graduate. I dropped out of school after the first year at Ryerson, which was in the 7th year. And actually left and started a computer software company. And I also became an investment advisor. So I'm a recovering financial planner. And I was actually recruited by Michael Lee Chin, who owns AIC Mutual Funds. I worked with him for 13 years, eventually becoming Assistant Vice President of AIC. And in addition, on the side, I had a software business writing financial software. So the financial software was on financial planning, portfolio management, mutual fund research, stock market databases, lots of different things. Eventually in 2003, and that's a business I started in the basement of my home. In 2003, I sold all of those companies. One of them was sold to Morningstar Research. Morningstar is the mutual fund database company in Canada. When they wanted to come to Canada, they actually bought my company. Since then I decided I'd get into real estate business. So I actually became a mortgage agent, and I started a company called Northern Range Capital to do financing. So primarily commercial and construction finance. I don't do residential mortgages. And about a year ago, I actually decided that I wanted to spend more time where it was warm. I don't like the winter. I don't like the snow. That's why this winter has been great, because we haven't had any. And so I started a company in Cayman Islands, actually, and I run a Caribbean real estate mutual fund called Heirloom Caribbean Real Estate Fund. And the company is called Heirloom Fund Management, is the management company. And actually 2 weeks ago, I was in Jamaica, I bought 87 acres of land to build a gated community subdivision, boutique hotel, and so we'll start that probably in the summertime. And in addition, well, I'm always looking for property and I'm always looking for money. So I raise money from investors into my fund, as well as raise money into mortgages, which I'm going to talk about today. And of course then, invest that money in different projects and so forth. So in the Caribbean, I have a project in Jamaica, one in Antigua, one in Barbados, one in St. Lucia, Turks and Caicos, Bahamas. So I travel around quite a bit. And the goal was that I wanted to be gone 1 week a month. So, especially in the winter time when it's nice and warm down south. So anyway, today I'm going to talk to you about investing in mortgages. And of course, for the last 10 years, a lot of people, having invested in mutual funds and the stock market, have not made any money. You know, if you look at their statement from 10 years ago and you look at it today, they have the same amount of money as when they started, or they've lost money, or they've made very, very little. And especially now that in this week where the U.S. government you know, announced that they're going to keep interest rates at 0% for the next, I think it's 2 years or 3 years, you're not going to make any money on your money if you have it in the bank, in a GIC, or even in the stock market probably, especially with all the problems that you have in Greece and Italy and in Europe. So what's the answer? What do you do? So the thing is, it's mortgages. So the agenda for today is how to invest in mortgages, how to use your RSPs to invest in mortgages, how to minimize your risk, and of course how to get a great return on your money. So hopefully I'll cover all of that today, and of course please feel free to ask any questions as I go along. If I say something and you didn't understand, please stop me and ask. So what is mortgage investing? It's actually also known as being a private lender, or being private lending. And it's where you lend money secured by real property or by real estate. So essentially you become the bank. So everybody complains about how the bank makes lots of money and they pay too much money in fees and all of that sort of stuff. So essentially you can do the same thing for yourself with your money. You can become the bank. So, like I mentioned before, with interest rates being so low, what's the alternative? Okay, so today you have GICs, or term deposits, are paying less than 3%. They're 2 point something for a 5-year GIC, right? Savings bank accounts pay 0, basically. Whereas in a private lending program, you know, you can make anywhere between 8 to 12% on your money, sometimes even as high as 15% return by lending out your money as a private investor. So that's more than 133% compared to putting your money in the bank. And of course, with stock market volatility, you know, it's whatever you get, basically. And oh, by the way, I have handouts, but I'll hand them out at the end of this presentation, and a couple of extra pieces of information and so forth. So why invest in mortgages? So mortgages, as you know, is secured by a tangible hard asset. Okay, so your money is secured the same way as when you borrow money from the bank and the bank takes your house as collateral or your property as collateral. The same way you have that your money secured against that particular property. And of course real estate appreciates over time, so actually a mortgage gets safer as time goes on, less risky, because hopefully as the property appreciates in value, and of course the mortgage is fixed, or if it's interest only, or paid down if they're paying principal and interest, your investment actually gets less risky or safer over time. And of course population trends are growing, so there's always a need for mortgages. There's always, the opportunity is always there for you to be a lender and lend your money out. And of course you're in a, like I mentioned, you're in a better rate of return than sticking your money in a bank account. So how's your investment secured? Well, essentially you get everything the bank gets. So you get a promissory note, the lender signs off, they promise to repay X number of dollars a month at such and such an interest rate for a certain length of time. There's a lien, a mortgage lien, that is a first, second, or even a third lien that's placed against that mortgage and registered in the land titles office. You get an appraisal, which the bank gets to make sure that what they're lending you is less than what the property is worth. They don't want to lend you more than it's worth, right? Title insurance in case of title fraud, fire insurance in case the place burns down, default insurance in case they go back, the borrower goes bankrupt. So you have lots of safety basically in a mortgage, because you're covered in a lot of different ways.
Bruce, can I ask a question now, or do you want to?
Yeah, go ahead.
Can you explain more about default insurance, how it works?
Well, default is CMHC.
Okay.
That's CMHC, you know, what I meant to see, you know, CMHC insurance. So, you know, if you put less than 20% down, you have to
How do you,
ensure
as
that
an
mortgage.
investor, how do you benefit from that?
You know.
How? Well, as a private, no, but you know, as a bank, yes. You know, so you get the, you know, in case the person goes bankrupt, the mortgage is covered, right?
But this is the private you are referring to. This is the private investment you are referring to.
Yes. So sorry. Actually, this morning I changed the default. It was liability insurance. Really is what you could get for as a private, right? Now, with a mortgage, you can also use your RSPs to invest, right? So, what is this? It's about holding a mortgage inside of your RSP, and the RSP gets paid rate of return or money back into that account, which is also tax sheltered, right? And of course, as security for the loan, you have the asset as security. Now, inside of an RSP, there's also qualified property. So not every piece of property could qualify to be inside of an RSP. There are rules around that. Oops. So what is a qualified property? Qualified property is that it has to be registered in Land Titles Office and has to be in Canada. So, and certain types of property are not, certain types of property do not qualify, such as co-ops, leasehold land, so forth, what they call chattel mortgages. You cannot hold inside. And agreements of sale is that you can't put a mortgage on basically on a contract. It has to be a hard asset. So as a private lender, you know, there are lots of steps to becoming a private lender. So what are the things that you have to do? Well, one, you have to find the deal. So you have to, you know, you have to let everybody know that, well, okay, I have money to lend, right? They bring their deals to you. So you have to find those deals. When they come to you, you have to evaluate the property. Okay, is it a good property? Where is it? Is it within the GTA? Is it outside? You have to decide what your lending criteria is going to be, right? Do I want to lend at 50% loan to value or 80% loan to value and so forth? So everybody has different criteria that they use to be what they feel comfortable with in terms of how much risk that they want to take on in being a private lender. You have to evaluate the borrower. Okay, does he have good credit? Does he have a full-time job? You know, how long has he been working there? All of the things that the bank does to you when you go to the bank to borrow a mortgage. Now you're in the bank's shoes, and you have to evaluate that particular borrower as to whether or not you want to lend. You have to do the paperwork, so you have to prepare. Okay, you got to go and find a lawyer to, you know, to draft all the paperwork and so forth. You have to understand what's in the paperwork, you know, and the contract. You have to also monitor the loan payments. So, okay, am I getting paid on time? Did he pay me, you know, a day late, a week late? Are the payments regular? All of those. So you have to administer the mortgage, essentially. And of course, you have to understand the foreclosure process. That's the other side of the coin, which is what do you do if the person doesn't pay, right? So after 15 days or whatever, okay, there you're going to start the foreclosure process or power of sale or whatever. So, or are you going to be a nice guy and decide, okay, I'll ease him up and give him a break. So is there an easier way? It's a lot of work. Being a private lender is a lot of work. So it's not that easy. So is there an easier way? Well, there is. Actually, there's two ways that I'm going to talk about today. One is mortgage investment corporations, or MICs, or a syndicate mortgage. And why are they easier is because everything is done for you. And all you have to do is just collect the payments. So I'll talk about mix first. And what it is, it's essentially a mortgage pool where you pool your money with other investors, and that money is lent out to in form of residential or commercial mortgages. And you essentially profit from in the position of the same way the banks do. Where the banks collect fees, you benefit from the fees that are charged for setting up those mortgages, for lending them out, and so forth. And of course you have diversification inside of a mix because you're investing in many different mortgages. Now you could consider that similar to a mutual fund that invests in mortgages, right? So, but it's really a trust. So it's a flow through. So the MIC I'm going to talk about today is greenback MIC, and the gentleman at the back of the room there, Anthony Burce, he is one of the principals of greenback. He introduced himself at the very beginning. So if I say anything wrong, I'm sure he's going to correct me. And now greenback MIC, they're located in Brampton, and with this particular MIC, the target rate of return is 10%. Now I say target because it's not a guaranteed rate of return. It's within the portfolio of mortgages that they have, is what they try to do is to allocate the money accordingly so that they achieve, a rate of return of 10% or even better. The minimum investment is $20,000. The interest is paid monthly, and of course you can use any registered account, so RSP, LIRA, TFSA, RESP. And also the nice thing about it is that there are no management fees if the rate of return is less than 8%. So,
Sorry, what's LIRA?
Locked in retirement account. So that's, if you had, people had pensions before, and they transferred it, when they left their job, they transferred their pension to a RSP. Basically, because it's a pension, that money is locked, and they can't withdraw that money before a certain age, essentially. Yeah. So, how do you minimize your risk inside of MIC? What are the things that they do? Because that's the first question that people usually have is, okay, what if I lose my money? What's being done to make sure that I don't lose my money? So, in the case of the greenback MIC, all property appraisals are less than 30 days, so they don't use old appraisals. They have to be current, and because property values change all the time, right? They lend only in the GTA and the surrounding area, so it's somewhere that they know, as opposed to lending up in North Bay or something like that, where you have no clue of what the market is like. And there are more than one MIC. This is just one. There's several others, and everybody has different criteria. Okay, so full application and credit check. So this is not ninja loans, no income, no job type of or stated income. It's that you actually have to fill out a full application and have a full credit check done. The mortgages are for 1 year term, so short term. So you have turnover. If you have turnover, then of course your risk is less because those mortgages are being repaid on a regular basis. The average mortgage in the MIC is about $41,000, so it's a small percentage of the total. So even if that mortgage went into default, for example, it'll have a very small impact on the entire portfolio, and therefore wouldn't really affect the rate of return that's being paid out to you very much. Of course, fire and title insurance to cover in case the property burns down or somebody trying to commit fraud or errors in title and all of that sort of stuff. Strong collection policy. So that has to do with making sure they get paid on time, every time. And if they don't get paid, then they act very quickly to recover the investor's money. So that is what that means, is that after, you know, I think it's a day or two, you call the client, they'll go borrow and say, well, you know, you missed your payment, you need to make X, come in with a certified check, and plus the NSF fees or whatever. And if they don't do that, well, then within 15 days, instruct the lawyers to start the foreclosure process. So there's no, well, maybe you'll help them out and ease up, you know, because it is the investor's money, that the other people's money that they're dealing with, and you have to make sure that you recover those funds. So because mortgages are, there's always new mortgages being issued, mortgages are being repaid, there's new money coming into the fund, so there's lots of turnover, which is a good thing because that helps to minimize the amount of risk within the portfolio. So the next thing I'm going to talk about is syndicate mortgages. So syndicate mortgage is a little bit different to a MIC in that it is where you have a group of investors pool their money. However, that money that's pooled acts as one mortgage against the properties. It could either be a first mortgage or a second mortgage. However, the difference is that every investor is registered on title in the registry office. So that's a unique feature to syndicate mortgages, as opposed to when you're in a MIC, when it's just a pool of mortgages and the registration is done to the MIC, not to the individual investor.
Excuse me, before we go deeper in this topic, on the previous one, what's the factual rate of return on for the greenback?
Well, they paid 10, but they collect more than that. So I think that the rate of return is 15%.
The portfolio is at 14.1.
14.
Pays 10, and on December 31st is an equalization payment. So you'll pay 10 monthly on the first every month, and you'll have a weird rate of return at the end of the year based on adjustments. So it could be 10.79. So depending on how many units you hold, you get a top up on the last day of the year.
Right.
Thank you.
You're welcome.
So you have a question?
Yes.
When you say each participant in the syndicate then is individually registered on title, does that mean any one of them individually can start foreclosure proceedings if there's a...
No. No. They don't. You have to. They all have to act as one. Yeah. And I'll talk about that when I get to the risks slide.
Right.
Okay, so in this particular example, I work with another company called Burce Real Capital, and they specialize in doing syndicated mortgages to developers. So this particular example here is a new project that they have in King City. This is one of two projects that they currently have on the go, but in the last 2 years they've actually done 19 projects. 6 of them were with Brad Lamb. If you know who he is, they call him the condo king downtown Toronto. He's built more condos than anybody else in the city of Toronto. And they work with established developers, people who've been in business for a long time and have a track record. So for example, this particular developer is called Pace Developments. They've been in business now, the owner, for 30 years in the construction business. In the last 10 years, he's built 3,000 homes, and he's also won Builder of the Year 3 times in the last 10 years. So in this particular project, it's 30 houses, so it's a small subdivision in a cul-de-sac actually that they're building, where but there is some additional land that's available. So one of the plans is to apply for a change in the density to allow them to build some additional townhouses or a 5-story condominium building. because in King City, it's in the green belt. There's a moratorium on building there. It's the Oak Ridges Moraine area. So there's not a lot of land available for building. So what they want to do is try and increase the density so that, of course, the investors make more money. So how their particular projects work is that most of them are anywhere from 2 to 3 years. They pay a fixed rate of 8% return on your money. But at the end, they have what is called a profit sharing. So the profit sharing is 12%. And how that is done is that in mortgage contract, there's a pro forma that's included. In the pro forma shows what the developer thinks he will make as in profits. So let's say the profit was $10 million. Essentially, if he meets or exceeds the profit, he will pay an additional 12%. So on a 3-year basis, plus the 12, 8 3 is 24, plus 12 is 36, works out to 12% a year. Now, with the King City project, the nice thing about it is because they're going to apply for additional density, is that if the townhouses are approved, then the back end is going to be 14%. And if the 5-story condo is approved, the back end is going to be 16%. So that's what they project. So your rate of return is going to go up a little bit more. Now it's prorated. So if the back end, if he makes less than $10 million as an example, then instead of you getting 12%, you may get 9%. If he makes more, then you get more on the other side as well. So it's a prorated number.
Up until which point of the project this investment is available to investors to actually decide to come in?
Well, until it closes. So it's
until the project closes, like the construction starts and...
No, they do a raise. So in this particular case, I think the raise was $3.2 million is how much they're raising. So once they've raised the $3.2 million, it's closed to investors. And you have to stay in for the term. So it's the thing about mortgages is that you know what you're going to get. You're going to get 8% at a minimum, right? You know how long you're going to be in for. You're going to be in for 3 years in this case, and you know when you're going to get your money back. So there's a specific date when of course the mortgage matures, and you're going to get repaid your principal. So that's one of the nice things, I guess, about investing in mortgages is that you know exactly what it is you're going to get out of the deal.
Is this to substitute the type of the mortgage that the builder will go to the bank and acquire, or is this to complement?
This is a second mortgage. So there's a construction mortgage that is in first place, and this mortgage is a second mortgage, behind the first, essentially. But you are secured against the land. So your
the construction mortgage is in place. The bank has approved the builder. The bank has already forwarded the funding, and then this is the second part. Or does this come first?
Well, this is the second, right? However, you have to have pre-sales, right? Because it's new development. So once you get to usually 70% of pre-sales, then the bank will provide the construction financing to the builder. So at the moment, if there's no mortgage on the land, for example, because they do many different projects, then this particular mortgage will be in first position until the construction mortgage is put in place. Then it will move to second, right? Because construction mortgage always has to be in first position.
So in case of problem, that mortgage will be paid out first,
Right, that's right. However, the loan to value on these projects are usually between 75 to 80%, the total for both mortgages, for first and second, right? So you are, there is a cushion there, a margin of safety in case. It's not 100% financing. Yeah. So how's, in the case of a syndicate mortgage, how is, or the way that Fortress does it, how do they minimize the risk? So one maximum loan to value 80% between first and second mortgage. The investment, again, is secured by a lien against the property, the asset, which is the land in this case. Bonded and insured builders. So all the builders have to carry what is called performance or surety bond. So a performance bond is actually an insurance policy against the construction or in case of developer default. So if the developer goes bankrupt, the insurance company will step in and finish the construction. Or in some cases, if there was errors in construction, so let's say if you're building a condo tower and let's say you got up to the 10th floor and realized that there was an error in construction on the 8th floor because they used the wrong steel or they didn't put something in properly. Then, in a condo tower, the only way to fix that problem is that you have to tear down the 2 floors, go back down to the lower floor, fix the problem, and then rebuild. So if you had a performance bond, the insurance company will take care of that. So every project has to have a performance or surety bond in place in case of those types of things. The other key thing is that no assignment of units by purchasers before closing. And that's a key, very key issue in that, as you know, most people, when they buy condos, they buy from plans. A lot of them, if they're investors, they buy with the intent of flipping the property before closing. In any project that Fortress does, they do not allow that. If you buy the property, you have to close. So the reason for that is, of course, to ensure that the builder wants to ensure that he's going to get paid for the units, and as you as the lender in this case, it means that